Okay, so we're on record now. So yeah, I think we just fire away, mate. So obviously, I'm Alex, AB Finance. We've got Josh Hawker, who's my BDM from Catalyst. Property Finance is one of the major lenders that we work with at AB Finance. We've worked with Catalyst and Josh for a number of years now. Obviously, done a fair amount of deals together. I just thought it'd be good to sort of get Josh on, and Josh agreed to just have a chat about the market from a bridges point of view, and also have try and shed some light on what we think is going to happen in the market, in the economy, and why sort of generally. And myself and Josh had a chat recently, and we thought we may as well be recording this and sending it out to our clients to sort of enlighten them as well, as opposed to just having a chat ourselves and then me trying to relay the message across. So yeah, first time I've done one of these, and welcome to Josh to have a chat, and yeah, just to tell us a bit about Catalyst, mate, and where we are, perhaps why we think sort of bridging rates are increasing, and because obviously we know that the base rates increased, and we know that means that banks are putting their rates up, and obviously it has a knock-on effect to the bridging lenders as well, as perhaps you can enlighten us more, but it's due to where the bridging lenders get their funds from, isn't it, in the main?
Yeah, absolutely. So yeah, thank you, Alex, for inviting me onto this and setting this up. I mean, like as you said, we've worked together for 3 years now, I suppose, isn't it? Multiple deals all through the pandemic, and then post that as well. So it's AB Finance and Catalyst have been working together pretty much since the start, really, which has been great. So Catalyst started in sort of 2017, but really started funding in earnest in 2018. We started with a team of just 2 people, which is my CEO, Chris, and our now Director of Credit, Matthew Gillen. And for the first few months, they pretty much did everything themselves. So it was really a proper startup. Chris, my CEO, was a very, very successful broker for many years. So Catalyst comes from the brokerage mindset of how to fund deals, and where we look to do a deal rather than not do one. So we look for reasons to lend, not to lend. And then 2019, I joined the team. I think I was the 8th person through the door. Now, as we stand today, we're up to a team of 25, and we've also got a sister company of 6 people, which in our estate agency business down here in Bournemouth, where Catalyst is based. We've got a sister company called Hive & Partners, which is an estate agency. So we've grown quite rapidly through that period, and we managed to keep the doors open all the way through the pandemic. I'll go on to how we're funded in a minute, but the way we are funded, we managed to lend every single day of the pandemic. We didn't shut our doors once. So that was, for a company our size and how much we lend, we really massively punch above our weight. So we're into the hundreds of millions of lending in per year now, going into 2022 and 2023. We actually had our end of year of September the 30th, so our new financial year started yesterday. So it's sort of a clean slate for us, and we're looking to sort of hopefully in a very turbulent market increase our market share as we did during the pandemic, because of the unique way not unique, but a very solid way that we're funded. We're able to really be quite agile and move to the market demands.
Yeah.
So yes, Alec, the last 6 weeks has been quite interesting, haven't they?
They have indeed, mate. Yeah. So obviously, we're both aware, as are our clients, that we've had 2 increases recently in the base rate, which obviously has resulted in, I know that we specialize obviously in bridging and development, which has obviously resulted in products being pulled. Other lenders actually across the market, even bridging lenders, have pulled products recently as well. So those products we are expecting. Say again.
There's a lot of uncertainty in the market.
There is. I mean, there's those products we're expecting to come back with new products that are obviously going to be more expensive, unfortunately. So, yeah, if we can just sort of delve into why that's happening, I suppose. Not too much of a back. I mean, obviously, the interest rates are rising as a result of high inflation. And yeah, if we just sort of set the scene, I suppose, Josh, there with the economy and the knock-on effect onto and interest rates and how that affects bridging rates, I suppose, as well.
Yeah, absolutely. I mean, for me, this all started in 2016 when Britain decided to leave the EU. Whether you think that's a good idea or not, I'm not here to discuss the sort of politics of that, but that has ultimately added to the issue that we've had with the pandemic. The furlough scheme, unprecedented times, and you'll probably hear me say that a couple of times throughout this sort of podcast. But yeah, really, with the furlough scheme and the amount of intervention the government had to do, where the country was pretty much shut for an entire year, on and off, there was always going to be fallout from that, and it was a heavily medicated market with stamp duty holidays and people, help out to eat out schemes and things like that. So with that, there was going to be some pain, and there was going to be a bill at the end of that heavily medicated market. And then obviously the war in Ukraine in February, when that started, that added to the issues. And then with obviously Brexit not fully sorted out when the pandemic hit, you've just got a perfect storm here for Britain to go into double-digit inflation. And what has caused that is obviously those factors there. Then the knock-on effect is the Bank of England's target is obviously 2%, as we all know. We're way, way, way above that. The only very quite crude lever that they have to control it is the increase in base rate. And over the last few weeks, what has been happening is the Bank of England have been putting rates up, and the government, in their wise knowledge, have been stamping on the accelerator. And obviously, if you've got the Bank of England pumping the brake and you've got the government hammering the accelerator, you're going to spin off. And that's exactly what we did last week, where the Bank of England had to put in £65 billion of stimulus to keep our pension markets afloat. So the knock-on effect to our industry in the bridging side of things is that with increasing base rates, the swap markets, so we actually, a number of our sort of funding lines rely on SONIA, which is the new name for the LIBOR, effectively. So it's a swap rates between the banks within London. And that rate there was very, very stable. It was, less than 1% for the whole of 2020, 2021, and majority of 2022. And then that started increasing dramatically as the inflation started getting out of control and the Bank of England started putting up their base rates. So SONIA went from less than 1% up to, well, I think it peaked last week at about 5.3%. So when our lending is benchmarks against that, we were able to put rates out the door, 75% loan to value, quite heavy refurbs, 0.69 a month, because our cost of capital was very low because SONIA was less than 1%, so was the base rate. Then all of a sudden SONIA goes to 5.3. I mean, this morning, as of the 4th of October, it was 4.8%, so it has dialed back a little bit on the 2-year swap rate. Because obviously we have to look at the 2-year swap rate, because a lot of our loans, although are 12 months, some of them are 18 months, and sometimes we have 24-month loans. So when we fix a rate at the start of our lending, we then sort of take on that risk for the entire period of that loan. Where if the client has got 0.89 a month, 0.95 a month, whatever, that's fine. If the SONIA rate goes to 8, 9, 10%, which if base rate goes to 6%, which there are rumours it could do, then all of a sudden our loan is not only not making us any money, as a lender, we're not a charity, obviously, we do need to make some profit. That loan then ends up costing us money, and then with all the risk that we've taken on as well. So that's why we look at the swap market rather than just the base rate market, because it projects where the base rate is going to go over that 2-year period. So that's why bridging lenders have kind of had to up their rates. People, like UTB and HTB, the banks and things that are lending their own money, they can hold their interest rates for longer, but ultimately they will. We've seen a lot of the time decrease in leverage. So Catalyst have stayed at 75% in the market. I think we're one of the last ones in the market to still be at 75% loan to value, whereas others are not advertising rate increases, but they're dialing back their risk. So where they're at 0.85 at 75% last week, they're now at 0.85 at 70%. So although outwardly it looks like it's not a rate increase, effectively it is, because they dial back their risk and they're at 0.85 at 70% rather than 75%. So what we've had to do with Catalyst is obviously manage our loan book, manage our pipeline of deals, which has been the most difficult, because obviously with some bridging loans, especially the more heavier refurb ones, with solicitors being under a huge amount of pressure and oversubscribed cases, valuers availability being very, very difficult to get hold of at the moment. The entire cycle that used to take sort of 5 or 6 weeks is now taking up to 3 months. So 3 months ago, if I priced a deal, we could have been 0.69, 0.75, but that's when our cost of capital against SONIA was less than 1%. And now we're at nearly 5%. Obviously, something's got to give. And from a lender's perspective, we are just as frustrated with this market as borrowers are. Because the reason being is that we've actually cut our margin in a lot of the cases with our current pipeline to get the deals done for the client to lessen the impact on them. So we're actually making less money out of these loans than when I priced them in July. So when we have these price increases, we don't take them lightly. We do try and minimize the effect as much as possible. But ultimately, we want to build our business. We want to still be in the market as we have for the last 3 years. We weathered the pandemic. We want to weather this increased rate market, and we want to carry on lending. And we can only do that with the help of our intermediaries. And Alex is a key intermediary for Catalyst and an introducer to us and a broker. And I'm quite proud to say that Alex was the very first broker to come to me and say, look, Josh, I can see the interest rates are going up. Is there a way that I can reduce my proc fee? Because we're very open here at Catalyst. We charge a 2% facility fee. We pay all of that to the broker. It's on our heads of terms. It's a very, very open book. And that's how we are as a company. We're very, very honest in what we're lending, how we're lending, what the costs are. There's no hidden fees in what we pay the brokers. So Alex said, what if I reduce my proc fee to 1.5%? Could you pass that saving on to the client? And my answer was obviously, yes, we can. So with AB Finance, where I'd be charging 0.95, 0.99, you're actually more likely to get 0.89, even 0.87, because Alex is taking a hit on his proc fee and we're able to keep 0.5%. So therefore we can pass that saving on to the borrower. So, and he was the very first broker to do that and actually phone me up. And we work with nearly 300 partners. So I was very pleased that Alex, one, wanted to set up this little chat that we're having now, and two, that he had the pragmatism to do that, because lenders are taking a huge amount of pain because our costs have increased dramatically and we're cutting our margins to the bone. Borrowers are getting absolutely hammered from both ways, with the cost of living crisis and the cost of materials going up hugely, and the cost of all the professional fees and everything just going through the roof. And now their lending has gone through the roof as well. But the brokers were still on their 2%. They hadn't felt any pain at all. Obviously, managing the situation is difficult, granted. But financially, they hadn't, seen a huge amount of change. So Alex coming to me and saying that I'll share some of that pain to give back to my borrowers, I was, very pleased with that as a solution. And I would urge a lot more brokers out there to do it, because it will lessen the impact on the borrowers and it will help lenders, stop these huge rate increases being such a problem to the wider market as well. So I just wanted to give you a virtual pat on the back there, Alex.
Yeah, cheers. I think yeah, as you mentioned, the main sort of reason for that is, as you've mentioned, obviously lenders are being hit and having to make less money basically, and their margins are being eroded. Obviously, borrowers, their profit margins are being eroded by the interest rates going up. And we're all about sort of hopefully building relationships for the future and showing clients that how client-centric we are. I mean, from my point of view, I think we do pretty well as bridging and development finance brokers. I mean, in development finance, we get 1%. All right, granted that a lot of those deals are bigger ticket deals, but I think on bridging, to trying to, it's all about trying to build relationships and show our clients that they come first, really, and trying to absorb some of that pain on their behalf, I suppose. So that's the reason why we said it. I mean, I don't want to medal for it, it's just to try and sort of show that we do put our clients first. And I think you were quite, I suppose, excited on the phone when I mentioned it, and then quite sort of taken aback and said, that's really a great attitude. But that's why we've done it anyway. I don't want to go on and on about it. Just hopefully our clients will realize that we are very client centric. Obviously we want to continue working with Catalyst. You guys have educated me quite, through my journey from over the years as well. So we're keen to build relationships for the future, obviously. So I mean, just moving on. I know you guys are a bridge lender. We've still got good products there available, obviously, and we're trying to absorb the interest rate increase. I suppose what I'm getting asked a lot, and I've asked you this question already, and we all wish we could have a crystal ball, but it's, how far do we see the interest rates rising? The base rates increasing. What do we see on buy to lets? Where do we see them in 6-12 months time? The $1 million question: how long do we bloody think this is going to go on? I know it's an impossible question to answer, isn't it?
Yeah, but I mean, obviously, being in the industry and doing a lot of reading, listening to other podcasts, and listening to the radio, news articles, things like that. No economist can say for certain when it's gonna stop. I think it all depends on how this government plays their hand, and the U-turn on the 45p tax is obviously a climb down on where they were, whether you agree with it or not. So again, I'm not here to discuss politics, but was it a good idea to put it out in the first place? I'll let you decide. Was it a good idea to U-turn? Again, I'll let you decide, because we've got a new government that has already made quite a big mistake. So I think that where we're going with this, again, it depends on the war in Ukraine and how quickly that comes to an end. Because again, the energy crisis and the food crisis caused by Putin's war is obviously having a massive global effect. Not that Russia's economy is that big; it's only the size of Spain's economy. But it's the sort of optics of it all, and people's focus, and there is a land war in Europe, and it makes markets nervous. So if that comes to an end quickly, or a certain point next year, I think we'll see steady rises. I think we'll see sharp rises in the sort of next quarter on interest rates, just to get inflation under control. We'll see if the government's energy cap on the spending for £2,500 per household helps bring down inflation, which, in my opinion, it should knock off at least 5% of the inflation. So once we get down to like 5, 4, hopefully even 3% inflation by potentially the end of the year, early next year, because people spend less during the winter anyway. Obviously, we'll see what happens at Christmas. Going into spring, hopefully that's when the interest rates will start to level out and peak, and then hopefully start to come back again, sort of mid part to the end of next year. So with the going back to our industry, obviously exit is key to our loans because they're such short term.
That's the main thing. Just because we operate, I suppose, just in the bridge, mainly in bridging and development. Obviously, bridging lenders and development finance lenders need to look at the exits as well, as do, of course, our clients. So the main concerns I think are profit, the margins being eroded with the interest rates being so much higher, and perhaps rents need to be put up from landlords to try and maintain that kind of margin. Perhaps, do you think that the market will be able to take those increases in rents? I mean, are landlords, tenants going to be able to afford increases in rents? Is that a feasible sort of option to put rents up? Do we think?
That's again $1 million question, isn't it? Because that would feed inflation as well if rentals were to go up. But
with these increasing in heating bills, can the economy, will the market withstand an increase in the rents? It's all obviously questions that our switched on clients are going to be asking, and it's a tricky one, isn't it?
It is. It's going to be a rocky road. There's no doubt about it over the next 12-18 months. What I would say is that in this market, there is opportunities. There's always opportunities in a turbulent market. And what we started to see, especially over the last 3 or 4 weeks, where it's really got very rocky, is the sort of the more semi-professional developers, I suppose you call them. Maybe they're professionals in their own right, doctors, dentists, solicitors, that have sort of a dabble in property now and again. They've been quite a mainstay of our borrowers over the last 18 months. I'd say they're falling away out of the market and just focusing on what they've got. And we've seen the true property developers coming back out of the woodwork, because they didn't want to buy at the height of the market. If you're a professional property developer, you never want to buy at the peak, because obviously there's only one way to go with it. And I think now that there are properties that are taking offers, they're having to drop their prices. This is the first time we've seen this in a number of years, especially in the hotspots like Manchester, obviously London, the home counties, even down on the south coast here. We've seen property prices going above their asking price very regularly. Lack of supply. So that has kind of come to a halt now. We've seen with our own estate agency here, where we've started to have conversations with vendors to actually drop their prices to actually secure a sale, or if we've got an offer in that's sensible, urging them to really think about and take it, because in the next 6 weeks, it might be interest rates might go up again, or they're very likely to go up again, and therefore, mortgages are going to become even more unaffordable, and property prices will undoubtedly take a hit again. So what I would sort of suggest to our borrowers going over the next sort of 12 to 18 months is just buy smart. If you know your area geographically, that you've got a property there that needs some work, you can get it done sensibly, you can get it done to a budget, and that's got a very good chance of selling with a decent profit margin, then it's worth going for. And there will be opportunities now where you can pick up properties at a lot more sensible money than you could do before. With the rental side of things, and if you want to expand your portfolio, again, buy smart. I know you do a lot of work with HMOs and things, Alex, so that might be the way to sort of difficulties, and Article 4 areas and things like that are everything. So it's always good to speak to a decent broker like Alex that can point you in the right direction and help give you some advice on that side of things. And if you've never done it before, point you in the right direction of other professionals that can help too, with architects and things that can help move you forward with that. And then us as well as lenders, we do a huge amount with HMOs. We do lend against, I'd probably say, I'd like to put a figure on it, but maybe even 30-40% of our loan book is sort of geared towards the sort of multi-unit freehold blocks or HMOs, things like that. So I just think you've got to buy smart. There will be opportunities out there.
I think that's a key thing, isn't it, as well, that to always mention that where there's adversity, there's always opportunities there that present themselves. So as I think we've both agreed, approach with caution and sort of stress test your exits if you are refinancing it at 7%, 7% interest rates. But there's always deals to be had, and if you're covering if you're covering your mortgage repayments and making a bit of money, in this climate, then you're set to do pretty well when we come out, aren't you?
Back to sensible levels, yeah, exactly. So I think also the other, what I'd sort of finish on with that is try and have a couple of exits. So if you are looking to maybe build a portfolio and maybe retain the house, always have a secondary exit. Like, if this doesn't work out and the finance does get too expensive to refinance, does it make money as a resale? And am I making profit out of the deal?
Yeah.
So, even in the good times, we always would prefer clients to have, sort of 2, even 3 exits available. So, but in these times, it's refinance, so potentially a very expensive buy-to-let mortgage, or it's sale. There's not much else. If you could look at a deal and appraise a deal to say, my first choice would be to get the rental in and put this in my portfolio. But if that doesn't work, I can sell it and I still make an 8, 9, 10% profit on it.
Yeah.
If that's the case, happy days.
It's all about looking towards the long run as well, isn't it? In property, it's everyone that, I invest in property myself. I don't know whether you do, but don't know whether we discussed that. But it's always looking in the long run and the long term, and it's always going to be, to re-emphasize, a pretty solid thing to invest in, isn't it? The good old English bricks, British bricks and mortar, anyway. So. I suppose I can't go on for too long because we've all got to crack on. But I suppose in summary, just I suppose keep calm and carry on, really. And
I think my sort of leaving words would be to. For investors would be to just work with a decent broker, one that's a very good cook. Posts on LinkedIn every day about what he's cooked that day. I think that's very important.
Yeah.
Also, someone who's got a selfie stick.
All fun and games. Actually, that's what's prompted this is that I'm trying to you'll have noticed, Josh, put out more and more content to educate our clients and show them, our knowledge. Everyone really knows I like my bloody food and eat too much, I like plastering myself on social media. But I think the key is that we've changed now and we're putting out more content, and this kind of sort of interview, sort of Zoom podcast, whatever you want to bloody call it, is going to be a more regular occurrence. And I think it's key in this climate that we're in to keep our clients educated and do what we can for them. And
exactly that. And to work with people you trust as well is a big thing, because in this market here, the cheapest might not be the best, because if you're going with cheap, it might not be quick, and if you're going with cheap, it might not be certain that the funding's there. And with Catalyst, we will work as fast as we can to get deals over the line for you to avoid any further interest rate rises. because we, like I said, every time we have an interest rate rise, it actually erodes our margin. It doesn't help us. So we want to get your deals across the line as quickly as possible. And also to work with people that have got the certainty of being able to lend. And with the way we are funded, we've got institutional funding lines that come from America. We've got institutional funding lines that come from, this country in London. We've got private individuals, high net worth individuals that invest into us. We've got, about 4 or 5 very, very solid routes to capital. And we've probably got access over a 12-month period to hundreds and hundreds of millions. And we do lend hundreds of millions each year. So, it gets to the point where you want to make sure that on the day, if you've got an exchange date and, that, or a completion date, if it's an auction purchase, that money needs to be there. And Catalyst is exactly that. When Chris set this company up,
I think the key is as well. You're always trying to diversify and bring new products to the market as well, and try and offer as the highest loads of values that we can, and try and really set yourselves apart, which is something you do well. So I think I think we've run through a fair bit there today. Perhaps have another catch up like this in mid-November, something like that, after the next.
The next meeting for the Bank of England is on the 2nd of November. So
exactly. Yeah.
After that, and see the fallout from that one.
Yeah.
There could be there's talks of a whole % increase in base rate on that date. So, but hopefully, it won't be quite that high. But we'll see how the economy fares over the next few weeks, and we'll catch up then, Alex. But,
well, great. Thanks very much, Josh. And that's Josh Hawker, my BDM from Catalyst, and obviously you know who I am, Alex Blakeborough, AB Finance. So, thanks very much, Josh, and we'll catch up again soon. Thank you, mate.
Thank you.
Bye.